Kitco Mining special coverage of BMO's Global Metals, Mining and Critical Minerals is brought to you by First Majestic Silver.
Hello and welcome back to Kitco Mining with me, Paul Harris, here at the 2025 BMO Global Metals and Mining and Critical Minerals Conference in Hollywood in Florida. Gold price is up and the better performing gold companies are performing even better. Joining me to discuss this is John McCluskey, President and CEO of Alamos Gold and one of Kitco Mining's 2024 CEO of the Year Award nominees. John, welcome back to Kitco.
Thank you, Paul. It's a pleasure to be here.
Another solid year for the company with record production of 568,000 ounces of gold, strong margin expansion, an all-in sustaining cost margin of about $1,300 per ounce, the growing cash position and a share price gain of about 100% year on year. Congratulations there. What are some of the things that pleased you most last year?
It's always a great achievement to exceed your production guidance. We actually exceeded the high end of our revised guidance, so that was a great achievement. We kept our costs right in line, so we're in an inflationary environment now, and being able to hold costs is a significant achievement. Of course, we did the Argonaut acquisition where we brought in the Magino project, and that has some very far-reaching positive implications for the company. So. And this was one of the few acquisitions that frankly anybody's seen where the acquirer of an asset saw its share price go up in value after the announcement of the acquisition. So, that market received that very, very positively. And I think it was because the synergies were just so obvious. What is maybe less obvious, but probably equally important for us, are the opportunities we have by virtue of the fact that now we sort of enjoy the permits that were put in place by Argonaut in that district. It means we're not permit constrained for anything we want to do with regard to mill expansion or tailings expansion in particular. And I think all of those things combined just made it a stellar year for us.
Well, congratulations there. I would say Magino is perhaps the textbook case of M&A with synergies, given the proximity of Magino to your Island Gold Mine. There was some more M&A action last night where it has a focus on Canada with the Equinox Gold tying up with Calibri Mining. They will have two large Canadian gold mines. It seems that having large or access to large long life Canadian gold mines is being a real driver for M&A transaction. Why do you think that is?
Well, probably the same reason why we decided to diversify away from Mexico over a decade ago and get into Canada. Safe political jurisdictions. That is very much resonating with the market. We saw that coming a decade ago, and we recognized that not only was Mexico becoming more risky at that time, but anywhere you looked in the world was becoming more risky. And of all the jurisdictions that you could operate in, Canada, in our opinion, was the best place to be. And the type of deposits that we are going after in Canada are the ones that just don't last for a season. They go for the long term. In most cases with open pit oxide, you're lucky if you can mine those deposits for a decade. More than a decade, you're happy as you can be. But when you're pursuing underground in the Canadian Shield, these operations can go on for decades and decades and decades. And there's examples of gold mines in Canada that ran for 80 to 100 years. So once you've tapped into one of those really good, high-grade, long-life deposits, you're in the mining business for the long term. And I think that's what's driven a lot of companies to look at Canada.
Now, at Alamos, you've got a growing cash position. And imagine you've got a lot to sort of digest still with Magino and Island Gold. But do you expect to see or even participate in more Canadian gold M&A?
No, I don't think we will. As you know, there's been a number of divestitures over the course of the last year. The Newmont assets that came up for sale, this recent merger, for example. I mean, we know the landscape very well, but you just have to look at the suite of assets that we already own and the organic growth potential that we have in those assets. I put it this way, it took us 20 years to go from a standing start to 500,000 ounces of production. Now we've got the wherewithal to go from that 500,000 ounce a year level to 1 million ounces of production and accomplish that by the end of the 2020s. And that's all organically driven. It's driven by the expansion of Island Gold, which, as you know, from a reserve perspective, it's just been growing in leaps and bounds. I mean, when we took it on, it was far under 2 million ounces in reserves and resources, and today it's just under 7 million ounces. You know, we've added nearly 5 million ounces at a finding cost of $13 an ounce. And as we were adding the ounces, the grade continued to climb, because as you go to depth, the grade gets better in this deposit. So it was 9 grams when we acquired it. It was 10 grams right up till the end of last year, and in our resource statement published last week, it's gone to 11.4 grams. And I think it's going to continue to climb because, you know, we're looking at the resources on the lower east of the deposit. There's a 2 million ounce block that grades over 20 grams. So as we convert that from resource to reserve, and we've got a 90% conversion rate, as we go through that conversion, you're going to see not only the ore body continue to grow in reserves, but you're going to see the grade grow as well.
John, I can tell you're getting excited about what's coming around the corner at the future. Scale, you're getting more and more scale, as you mentioned, going from 500,000 ounces up towards 1 million ounces per year. As you mentioned, the grade's improving as well. So if the gold price stays where it is or continues to improve, which many commentators think it will, the cash generation potential of these assets seems to be going off the charts. As a CEO, I guess that gives you a new kind of responsibilities, what to do with all that cash, how to use that sensibly, or how to guard that sensibly for your shareholders.
Well, we've never had a difficulty with that. You know, we probably have one of the best track records in the industry for asset allocation, and you've got to put yourself in our shoes for a second and try to imagine what it might be like to sit on an asset like Island Gold. I mean, it was very small when we first acquired it, and people thought we were nuts for buying it in the first place. And it is more than tripled in size since that time, since we first acquired it, and that's net of depletion. You know, we've mined over 1 million ounces there. Here's the thing, you know, does it top out at 500,000 ounces of production, or is there capacity to push it beyond that? Well, we can already see with the existing shaft and with the expansion of the open pit operation, you could boost production from underground with existing infrastructure to 400,000 ounces a year, just through organic development. You could push that open pit operation by doubling the milling capacity. You could push that production to about 200,000 ounces a year. So suddenly you're taking this camp, which currently between the two operations is generating roughly 200,000 ounces a year. Just through organic growth, you can push it to 600,000 ounces of production at $1,000 all-in sustaining costs. Now, if you assume a $3,000 gold price and no further growth in the gold price, you're talking about a $2,000 pre-tax margin on 600,000 ounces of gold. That's $1.2 billion in cash flow pre-tax. I mean, if factor in the tax and so forth, you're probably still talking about over $700 million US in free cash flow generation. You know, that is what we're really focused on. We're not trying to, you know, produce more and more and more ounces. We're trying to maximize the profitability of every ounce that we produce.
I mean, there's some big numbers there, John, and it sounds in some ways, it sounds like a similar opportunity to what Agnico Eagle Mines is looking at doing or is doing with its Malartic mine in Quebec. You know, going deeper, expanding the resource, making a good asset even better, or great asset even better.
It's a very similar approach. The drive is organic growth. Why? Because, well, you own the asset already. It's fully permitted. Not only are we fully permitted, but as I mentioned earlier, we've got the wherewithal, if we want, to increase throughput to 35,000 tons a day. Those permits are in place. The tailings capacity is far in excess of what we need for both ore bodies based on known reserves, which which look out to something like 20 years of production. So, essentially we have all that optionality that only begins to come into view as you see this rising gold price. The gold price goes higher and higher, and investors ask themselves, well, can they produce more? And usually the big constraints are you don't have enough reserves, or you don't have enough infrastructure. You may have a shaft, but it might be too small. You might be permit constrained. Well, we're not constrained with any of those things. We have the infrastructure, we have the reserves, and we have the permits. Now we just need the time to build it out. And as we do so, we continue to drill. Like we've got a $70 million exploration budget in 2025. Think about what we could achieve with that when our finding costs are $30 per ounce. We're looking forward to adding a lot more ounces to our reserve and resource picture over the course of 2025.
Now, the gold price is a stone's throw from $3,000 per ounce. And here at BMO Metals and Mining Conference, there's a lot of smiling faces around. But are you seeing smiles on investor faces yet?
Well, we're certainly seeing smiles on Alamos Gold investor faces. I mean, we're up 200% over the last 3 years. And as you mentioned earlier, the chart over the last 12 months shows us up about 100%. So it's been tremendous share price performance. And, that's been driven by, growing production, expanding margins. So we're making more money on all those ounces that we're producing. And while we do that, we're more than replacing the reserves that we're depleting. We're actually growing in absolute terms. So, yeah, the value of Alamos shares is climbing, and it's driven by per share metric growth. So we have more reserves per share, more cash flow per share, more earnings per share, and that's essentially what investors are looking for. It's a great position to be in, and I think it's a position you arrive at when you've had a very disciplined approach to building the company, and I don't see any real reason to upset that. We've been doing the same type of thing for a very, very long time. It's just that as we accumulate the years, and we've accumulated more assets, and we invest more money in production development, in reserve development, it just becomes an ever more valuable company.
Now, your existing shareholders, I imagine, are very happy, and you're telling me that they are. But is your performance enabling you to attract new investors?
Well, I think it is, because if there's one thing that investors have learned is they never do badly when they bet on the right jockeys. So if you look at the industry, you look at the Ross Beatties and the Clive Johnsons and the Sean Boyds, and you look at this group of people. Pierre Lassonde is another name that comes to mind. They're consistently successful over very, very long periods of time. Now, why is that? It's because they're very diligent in the type of assets they work on and develop. They're very disciplined in the way they run their businesses, and as a result, they're successful and things grow. We like to think we're doing the very same thing. We're very disciplined about what we're doing. It's not like, tomorrow we're going to wake up and just have a completely different idea about how we're going to run the company. We're not. We've got a very clear idea of where we're going. It's now, there was a time, going back to between 2015 and 2018, when the gold price was trading between, say, $1,100 and $1,300 an ounce. We were very aggressively acquiring things, very aggressively. But now we have those assets under our belt. Now it's a question of investing in developing those assets and turning them into profitable mining operations and ever bigger mining operations.
Well, given your performance and your history of successful M&A, John, I'm sure the name John McCluskey is going to be added to that list of names you just reeled off at some point in the future. Now, investors are happy. Gold price is great. You're making cash hand over fist. Are we getting to a situation now, or again, where investors want growth? We've come out of some capital discipline years during the bear market. Are they now looking for growth?
They are, and I have to say that the backbone of our shareholder list, those investors have always wanted growth. I mean, what are you doing if you're not growing? That's a question to ask. In the mining business, you're never standing still. You're either depleting your resources, which means you're basically on your way out of business, or you're growing. And the companies that decided to grow under any circumstances back in that 2010 through 2013 period, where they were doing top of the market style transactions, really overpaying for assets, only to be caught in a downdraft in the market that basically came in 2013 and lasted until 2020 practically. I mean, that really gave investors pause. They looked at this sector and thought, we don't see any discipline. We see a lot of value destruction through that type of irresponsible M&A. And you can't disagree with them. But we never did that. When everybody was going crazy doing top of the market transactions, we built cash. And then we had a treasury with about $400 million, which we had built up through retained earnings. And then we deployed that to acquire assets on very attractive terms, which now we're capitalizing on. I mean, that's the way to do it. It's a cyclical business, and if you're playing the cycles properly, you're buying at the bottom, and then you're building and then producing and rendering profits as the commodity goes up in price.
Okay. Now, Alamos Gold returned about $41 million to shareholders last year through your quarterly 2.5 cent per share dividend. This barely gives any yield, and certainly not enough to really attract any investors. So my question is, why bother? Your share price was up 100%. Surely that share price appreciation is what investors are really after, rather than dividend or dividend yield. So wouldn't gold companies be better using that money for their growth initiatives?
Yes. But, it comes right down to this. You've got a very broad spectrum of investors that hold your stock. And, there was a time when the market was in very bad shape, back when the gold was, $1,300, $1,400, $1,500 an ounce. And we were trading at 0.0 times NAV, and our dividend yield looked like almost 2%. And we're not trying to be a yield stock. That's never been our objective. But we do believe in paying returns to investors. So the idea is to, we can keep the shareholders happy that are looking for some dividends, but at various times, different things are going to matter more. So there was a point in time when M&A mattered a great deal. Right now, development matters. So exploration and development, that's our big focus. But the time is going to come where we've effectively, built out such an attractive growth pipeline. We'll have production up around 1 million ounces a year, hopefully enjoying, $2,000 margins on that million ounces of production, which means we'll be generating substantial amounts of cash flow. I mean, between now and 2028, we have a pretty substantial capital spend in order to build out all these assets. But once it's done, that capital spend comes off, and our cash flow starts to soar. At that point in time, we can absolutely afford to pay a higher dividend, but it's never going to be our objective to be, like a dividend stock. It's not our objective to be, a 6-7% yield kind of company. There'll always be, I would argue, there'll always be better places to search for yield. But what we can be is a highly profitable company that offers our shareholders excellent exposure to gold, that unlike an ETF that has to go into the market and pay prevailing market rates for every ounce it acquires, as I mentioned earlier, we're finding gold at Island, for example, at $13 an ounce, but across all our assets, our average finding cost is $30 per ounce. At that rate, don't you want us looking for and finding more gold? So I would rather be spending $70 million on exploration than in increasing the dividend. You could argue, why spend money on exploration at all? You've got 20 years of reserves out in front of you. It's because those assets are so valuable, and we're adding ounces that aren't 20 years out in terms of production. We're adding ounces that we can actually reach and bring into production in the short term.
I take on board your point, John, but let me play devil's advocate. With that $41 million that you returned to shareholders last year at a discovery cost of $30 per ounce, you could increase your exploration budget this year by 50% and find me a whole bunch more ounces.
You think you could do that, but it isn't a question of just throwing money at it. You need people, you need drill rigs, you need drill contractors. There's a lot that goes into doing that, and we have a very big exploration group right now, but as big as it is, we couldn't handle much more than a $70 million annual budget.
That's fair enough, I suppose. Now, let's end, if I may, with some forward-looking statements. What are some of the sort of key milestones this year for the company?
Well, we're working on a few things. Clearly, again, meeting production and cost guidance. That's always top of mind for us. We've got a plan to reach 600,000 ounces of production this year, and when asked that question, I always envision who's listening in, and I imagine, quite a number of my employees are going to listen to this, and so I want to make a point of saying, we want to be one of the safest mining companies in the world. And, the tolerance is zero tolerance. We want no accidents at our operations. And as a result, we put a very strong focus on safety. So for all those employees that might be listening in, I hope they take that message loud and clear. So being a safe company, being an environmentally responsible company, being a highly profitable company, and of course being a growing company. We want to execute on all of our growth objectives, and ultimately we want to show the kind of returns that our shareholders are actually looking for, which are the capital gains. And as time goes on and we increase the value of our assets, the analysts are out there looking at all that work, and they're turning that into ever higher valuations on our shares, and the share price is growing. And I expect that as successful as we've been over the last 5 years, with the way the gold price is running, and if you look at the growth trajectory of our specific company, we've got some great years ahead.
Excellent. Well, I wish you continued success. John McCluskey, Kitco Mining CEO of the Year Award nominee, thank you very much for joining us today.
Thank you, Paul.
And we have a lot more to come from the 2025 BMO Global Metals Mining and Critical Minerals Conference here in Hollywood in Florida. So hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining special coverage of BMO's Global Metals, Mining and Critical Minerals is brought to you by First Majestic Silver.